Everyone can do well in the stock market. You have the skills, you have the intelligence. It doesn't require any education. All you have to have is patience, do a little research. You've got it.
Imagine this, you, a master of the stock market, achieving an astonishing 1,800% gain. Sounds impossible? Think again. This is the explosive of Peter Lynch, one of the most successful money managers in history. His story is not just about extraordinary financial success, but a testament that with intelligence, skill and patience, anyone you can excel in the stock market. So, buckle up, as we're about to embark on an adrenaline-fueled ride into the financial wisdom of Peter Lynch.
In 1990, Peter Lynch retired as manager of Fidelity Magellan, the nation's largest stock mutual fund, and one of the most successful. In 13 years, he drove Magellan to a 2,800% gain. Quite simply, Lynch has been recognized as one of the greatest money managers ever. He beat the stock market for so long not by timing the market, but by picking the right stocks.
For 13 years, I managed Fidelity Magellan Fund. Those were 13 amazing years. 9 times the market declined by 10% or more, and I was very consistent. All 9 times Magellan Fund fell 10% or more. I learned a lot of lessons. I think they're true now. I think they were true 20 years ago. I think they'll be true 20 years from now. I think I can help you do a better job of investing.
Peter Lynch's remarkable 13-year tenure at Fidelity Magellan Fund saw a mind-boggling 2,800% gain. Let that sink in for a moment. How did he manage this feat, you ask? Lynch was a master of buy what you know, investing heavily in consumer-driven companies. He believed in the power of observation and intuition. His keen eye for potential growth sectors and undervalued stocks led to astute investments that yielded high returns. Lynch also emphasized the importance of research, patience, and long-term investment, proving that quick fixes are not the way to sustain success in the stock market. Peter Lynch is here to help you find your winning stocks. Stay tuned as we explore the fascinating world of stock market success.
You may be wondering why stocks are so important for a long-term investment program. The short answer, over time, stocks produce better returns than other investments. The past 60 years, stocks have returned about 10% a year. Bonds have averaged 6% a year. Treasury bills or bank CDs around 3%. That doesn't seem like a big difference, does it? But the power of compounding makes an enormous difference over time. Suppose you invest $50 a month and earn 6%. After 30 years, you have over $50,000.
Lynch emphasizes on power of compounding and tax-efficient investment strategies. The focus is to provide you the better returns on investment.
When your investment is taxed, the government reduces your return every year. If you know you won't need the money until retirement, you should place as much of your investments as possible into tax-deferred accounts, like IRAs, KIOs, 401k, or 403b plans. Because you don't pay taxes on the money until it is withdrawn from the accounts, the power of compounding achieves the maximum effect, providing you the best return possible.
The more time you have to let your earnings compound, the better results you'll get. A 20-year-old who invests $200 a month and earns 10% on his money all along will have $1.1 million by the time he was 60. A 35-year-old would have to invest $800 a month to have the same $1.1 million at age 60. You're going to have a tough time getting that 10% return without at least some stocks in your portfolio. Before you start to invest, ask yourself one question. When will I need to use this money? The stock market is a long-term investment. If you need to use the money anytime soon, you should not invest in stocks.
This is money you're willing to put in the market and leave it there for 5, 10, 20, 30 years. That's the kind of money you can do well with. If you're worried about it, don't invest it. The stock market is volatile. Individual stocks are volatile. The average range for a stock in a year is 50% between its high and its low. Stocks go up and down. The market goes up and down. If you're investing with a 1 or 2 year time horizon, you shouldn't be in individual stocks. You shouldn't be in equity mutual funds.
Ever wondered why stocks are a better long-term investment than bonds? Over a 10, 15, or even 20-year period, stocks have consistently outperformed bonds and bank certificates of deposits. However, in the short term, it's not a guaranteed win. For instance, in 1987, the S&P 500 took a 33% nosedive from its August peak to its October low point. If you had the grit to endure that dramatic drop, you'd notice an intriguing outcome. From 1987 through 1992, the S&P 500, despite its decline, still managed to outperform treasury bills and long-term government bonds.
If you want to double your money quickly and safely, fold it in half and put it in your wallet. Any other way, you're simply gambling. A good stock can take 2, 3, even 5 years before it really pays off. It's not 2 or 3 weeks. It's not 2 or 3 months. My best stocks have been in my 5th, 6th, 7th year. Give your investments time to grow.
Many people ask me, when is the right time to sell a stock? Selling stocks is a matter of comparing stories. If story A is better than story B, then sell B and buy more A. You have several things that you possess that will make you a good investor. They're inherent to your life. It's the field you work in. It's the area where you live. There may be some local company that's terrific. You're a consumer. You see some products, you see some services that are terrific.
Back in the 1950s, a fireman from New England noticed the factory in his town seemed to be hiring and expanding all of the time. This person didn't have a computer, he wasn't a professional investor, he was just an observant neighbor. He decided to put $2,000 per year into Tan Brands, then called Tampax. By 1972, the fireman was a millionaire just from using his local edge.
Investing is a personal thing. You have to do it by yourself. You don't do it with a committee. You have to be able to have the emotional strength to stand the volatility of the market in general and stocks in general. The key organ here is not the brain. It's the stomach. Do you have the stomach for this? Do you have the patience for it? You should be able to look in the mirror and say to myself, what am I going to do if the market goes down? Research is exciting. It's very little math. When I owned Chrysler, it was the biggest position in my fund. When I was at a movie theater, at a sports event, I'd run into somebody driving a minivan. I'd ask them, what do you think of the minivan? Would you buy another one? What do you like about it? Some would say, well, it's a little underpowered. They only have a 4-cylinder engine. I knew they were already working on a 6-cylinder engine. So this is research.
Research starts with the things you know, your edge. If you're a mechanic, look at the tools you use. Which are the best? Which are the best value? Or if you're a doctor, see what new technology saves the insurer money, or software systems that reduce costs at hospitals. You probably already know a few companies quite thoroughly.
The amateur investor probably can follow between 5 and 8 companies. They could lecture in these 5 or 8 companies. They know them very well. There's 10 to 15,000 public companies in the United States. There's lots more overseas. So you don't have to be experts on lots of companies. You just have to know a few very well. McDonald's earnings have gone up, I think, more than 80-fold over the last 30 years. The stock's gone up 100-fold. What made McDonald's earnings continue to grow? If they just stuck with a cheap cheeseburger and a cheap hamburger at lunch, they probably would have run into earnings problems 10, 15 years ago. But they expanded their menu, they kept their costs low, they added breakfast, they went overseas. Every day they add 2 or 3 more restaurants. People thought there was no room for more McDonald's 5, 10, 15 years ago. They were wrong. If they had done the research, they would have said, well, there's a couple hundred countries out there. There's lots of places to grow.
Actual bad economic news, rising interest rates, wars, elections, any of these can push the market down. If you're one of those people that pore over graphs, economic statistics, or astrology charts, trying to figure out what the stock line is going to do next, you're wasting your time. No one can predict the market.
You have to understand the market goes down. There's been 95 years this century. We've had 50 declines of over 10%. Of those 50 declines, 15 have been 25% or more. So about once every 2 years, the market falls 10%. About once every 6 years, it falls 25%. These are big drops. You have to understand that. That's the nature of the market. Behind every stock is a company. If the company does terrific over a long period of time, the stock will do terrific. If the company does lousy, the stock's going to do lousy. That's all you're betting on. Putting stocks into categories is the first step in developing the story. At least you'll know what kind of story it's supposed to be. The category tells you what questions you should be asking about a company.
Basically, you simply can't expect all stocks to behave the same, basing a strategy on general maxims like sell when you double your money or sell on the price falls. 10% is absolute folly. No formula will apply to all stocks. Different stocks behave differently, so they require different approaches.
There are basically 5 categories. 1 would be fast growers, 2 would be slow growers, 3 would be cyclicals, 4 would be asset plays, and the 5th one would be turnarounds.
Almost all companies change categories at some time throughout their lifetimes. Fast growers, if successful, will always eventually slow their growth. They'll run out of places to go. Cyclical companies experiencing long down cycles may become turnarounds. Once recovered, they probably will be cyclical again. Use the categories as guides to help you.
The beauty of growth companies is you have plenty of time. If they're going to grow for 5, 10, 20, 30 years, you don't have to be there the first year or the second year. You could have bought Walmart 10 years after they went public and made 30 times your money.
What makes a company grow earnings so quickly? Either it is a rapidly growing industry, or it's a rapidly growing company in a slow growth industry. Rapid revenue growth and rapid earnings growth are the hallmarks of a fast grower. But you just can't buy any stock with hot earnings and hot sales. You have to check the balance sheet and make sure the company can keep growing.
A normal baseball game has 9 innings. You should look at a growth company and say, I don't want to buy it when they're in the first inning. I want to buy it when they're in the second or third inning. They've got the formula right. They've got lots of room to go. So you want to say to yourself, this is a company that's very early in its cycle, like a McDonald's when they're only in a few stores, or limited when they're only in 100 stores. And they had lots of malls to go to. Microsoft was a company you could have bought 3 years after it went public and made over 20 times your money.
He demonstrated that with the right approach, anyone can navigate the financial markets effectively. His tenure offers invaluable lessons that still hold true today. But why are stocks such an essential part of any long-term investment plan? Well, the answer lies in 3 key components: compounding, tax advantages, and patience. Firstly, the power of compounding is a financial phenomenon where your earnings generate even more earnings over time. It's like a snowball effect that can turn your small investment into a substantial sum. Secondly, stocks held in tax-deferred accounts like IRAs or 401(k)s can grow without being taxed until withdrawal. This means more of your money stays invested and continues to compound. Lastly, patience is vital. Investing is not about getting rich quick. It's about steady growth over time.